You want to eat at a 5-star hotel, but you also want to split the bill with your friend. That's exactly what option spreads does. It gives you the same meal, but with limited budget and limited risk. Hi, I am Pranav VK, an NISM Certified Trader and Trainer and your options guide here at Stockshala by Kotak Securities. In this video, we are going to start diving deeper into multi-leg strategies and also something called as spreads. When you trade with single option contracts or single legs, you're either completely bullish or completely bearish on your specific trade. But real-world trading isn't always black and white. Sometimes you would want to bet with a bit of protection or even reduce your cost. And that's exactly what option spreads helps us do. Let me help you with a real example so that you understand how option spreads helps with this specific pain point. Assume you want to do naked buy selling. It has unlimited profit potential, but also the decay is super fast and high premiums. So instead, if I do a spread, it will have a defined risk, a defined profit, and as well as enough time for me to make decisions. It's like renting a car but capping your fuel costs. You know the speed, distance, as well as the damage beforehand. Now let's understand the exact definition of option spreads. An option spread is when you combine two options of the same type, either call or put, and you're going to take different strikes or even different expiries, but one contract you will be buying and the other contract you will be selling. Now let me help you understand this with an example. Let's assume that you're going to sell a call option of 19,600 by receiving a premium of rupees 100, whereas you're buying a call option of 19,400 and you're paying a premium of rupees 50. Now, the difference between these two premiums is going to be your potential profit or your potential loss, depending on how the market is going to move. Also, in this case, when entering into this spread, since you're receiving a higher premium than how much you're paying, it is also called as a net credit spread. Now for this exact same example, let's also try to draw a payoff diagram so that you understand this concept very clearly. In the previous videos, we have learned how to draw payoff diagrams. But now what we'll do is, since we have to combine two different contracts for the payoff diagram, let's first individually write each of the payoff diagrams and then combine them to see the actual payoff of the entire spread. To start with, we'll start with the sell call. So this is going to be our profit or loss, and this is going to be our strikes or the prices of strike. Now the sell call is going to look something like this, where we are going to have an unlimited loss potential and the limited profit potential. And the limited profit potential is to the extent of the premium that we are receiving, and that is rupees 100, right? Now similarly, let's also draw a payoff diagram for the buy call option, that is 19,400. And now for the buy call, we are paying rupees 50 premium to get into the contract, and the payoff diagram is going to look something like this, where it has unlimited profit potential. So as you can see, we are combining something which has unlimited loss potential and with something that has unlimited profit potential. And once we combine both the payoff diagrams, we are going to have a beautiful payoff diagram that looks like this, where your maximum profit is also limited, but at the same time, you're also able to reduce the maximum loss, and which is limited. So now you have converted something that had unlimited loss potential to limited loss potential, but it also comes with a drawback that it goes from unlimited profit potential to limited profit potential. But as we have discussed so far, risk is more important than profit. Now let's discuss about the different types of spreads. There are basically two types of spreads. The first one is called a net debit spread, whereas the second one is called a net credit spread. In a net debit spread, you pay more premium than you receive. But whereas in a net credit spread, you receive more premium than how much you pay. Think of debit spreads like equivalent of option buying, but with limited costs. But whereas option selling is equivalent to a net credit spread, where you have limited loss potential. Here's an analogy to help you understand this concept better. Imagine a debit spread is like investing in a business. If things go your way, then you book a profit. A credit spread is like lending money. You get paid upfront, but if things go wrong, you might lose more money than how much you make, which is very similar to how it happens in a credit spread. Now let's discuss why spreads are so powerful. The first reason is that it limits your risk and it defines it beforehand. So you have a very defined risk right from the start. Second, the margin requirements go lower because the broker will give you higher leverage if the risk is reduced. Whereas in naked selling, if you have to sell a single contract, then you might require 2 lakh rupees. But at the same time, if you go for a net credit spread, you might require less than 45,000 rupees. And number 3, it can be theta friendly, especially if you go for net credit spreads because it is equivalent to naked option selling, but with limited risk and limited margins. And finally, the fourth is it is perfect for range bound or sideways markets. The best part about option spreads is that it will help you plan your trades like a chess player and not like a gambler. Let's talk about in what scenarios we are going to use spreads. We know that we are going to do naked buying or naked selling when we are extremely bullish or extremely bearish. So, which means spreads come into picture when the market is sideways or moderately bullish or moderately bearish. Now, when we talk about net credit spreads, in net credit spreads, there are 2 ways you can enter into it. It could either be through a bull put spread or it could be a bear put spread as well. Depending on your market view, you can enter into multiple spreads. It could either be a net credit spread or a net debit spread. For example, let's say you are moderately bullish on a specific stock or an index. In this case, you can either go for a bull call spread or you can also go for a bull put spread. And in this scenario, you are expecting the market to be upwards. Whereas, if you are expecting the market view to be moderately bearish, in this case, you can go for a bear call spread or a bear put spread. And in this case, you are expecting the market direction to be downwards. And finally, if you expect the market to be in the sideways, then you can go for an iron condor or a strangle strategy, where you're expecting the market to be in a range bound for a specific period of time. Now you must be wondering, Pranav, what are all these analogies? What is bull call? What is bear put? Don't worry, because we'll be covering each one of these in the upcoming videos one by one so that you can learn them and execute in your strategies. To win in options, you don't have to predict the entire movie, but all you have to know is what is going to happen in the upcoming scene. And that's exactly what option spreads helps us do. It helps us make smart, calculated bets with defined risk and reward. So let's summarize what we have learned so far. We have learned that option spread is nothing but combining 2 options of the same type, either call or put, and with different strikes or expiries. But one contract will be selling and the other contract will be buying. The best characteristics of an option spread is that it helps you limit your losses as well as defined profits. And finally, you can use option spreads when you are moderately bullish or moderately bearish, and even when the market is sideways or range bound. Now that you've understood what a basic option spread is, moving forward, let's break down each of these strategies and understand them in depth. You're watching Stockshala by Kotak Securities. Go ahead, share this with your friends. I'm Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.